Yeah, so here we are, November 4th, 2021, episode 1 of Creating Wealth with Michael Douville and Paul Lowe here in the beautiful Scottsdale, Arizona. We have a lot to talk about today, given the recent news with Zillow announcing layoffs and getting out of the iBuyer market. Michael?
Good morning, Paul. How are you? It's good to see you again.
Yeah, you too.
So yeah, Zillow's been around for maybe a year or so here, but there's lots of players here. Of course, Phoenix being the number one market in the United States, we've had plenty of REITs here. They've been here for many, many years. Very, very successful REITs buying single-family homes. They're one of our people that we buy. Zillow came in and entered the marketplace in a reasonable amount of way. I know people say there's 2,900 homes or so. I think it's been thrown around for a little bit as to what's in their portfolio. It sounds like a lot of houses, but you have to remember there's 4.5 million people here. So 2,900 homes may affect our market for. If we sold them, the entire portfolio would only add 10 or maybe 2 weeks worth of inventory. So it's significant, but it's not terribly significant. I think it's significant for Zillow, but not terribly significant for the entire market here in Maricopa County. So sure, we've been wondering how they're making any money for a long, long time based on us being in the marketplace, being in the trenches, so to speak, and then watching what they're doing. So sure, of course. Yeah, and that's a really good chart. I mean, I love that chart. And can we blow that up a little bit so we can see that a little bit bigger? Yeah, there we go. Sure, of course. Now, one has to ask, we have had a terrific marketplace here. We've been talking about my model, talking about going into the accumulation phase for really after the recession in 2020. The market really just took off. It was just absolutely terrific. You can see that. It went really, really well. And Zillow stock, they came into the market and their stock did very, very well. But then they didn't make any money. So they started falling. Now, this has been one of the greatest markets we've had in 10 or 15 years. Just been a terrific market. And if you can't make money in this market, the market is the stock market. Now, remember, I'm in the real estate business, but people forget it's a fairly expensive business to be in. I mean, we have profit margins we have to be concerned about. We have expenses we have to be concerned about. And I don't know that Zillow was watching the store.
Yeah, today, we were talking a little bit before the broadcast here that the market has been extremely strong. And we know Zillow is very flush with cash, as you have to be with the real estate market. And, they did really well with their run-up, with the highest price at one point of $197 for their stock. And then things just really plummeted. And how do things plummet? How does your stock plummet in such an up market? And although that's not the focus of today, I understand that, but maybe
one has to say that the market, when it peaked, it had great expectations. But once you start realizing that the model itself is not working, that's where people started abandoning it. Now, you don't necessarily have to make a lot of money. Your model just has to be correct. Now, Amazon did not make a lot of money, never turned a profit for years and years and years. And yet they kept getting more valuable each and every year because the model was a very, very successful model. And even in a stock market, looking into the real estate market, they realized that there were problems at Zillow. I think that's what you're alluding to, because this chart shows what they lost. How much did they lose on this one, Paul?
So in the fourth quarter of 2020, they beat their earnings per share by 47%. But in the third quarter of 2021, they missed their mark by minus 675, call it 676%. Now that's a pretty huge miss. And if that was you and I in that kind of situation, we'd be out of business. So
long before getting to Q3, because they lost. I think the number being bantied about is over $500 million. $500 million. It's $500 million in losses.
exactly.
That's. I mean, we'd have been out of business long before then. You know, and my investors would have abandoned me long before we got to this point, because we're charged with making them money. Not on a hope and a prayer. We have to make money. So very, very interesting. Yep, absolutely.
Yeah. Because on a local level, we run our margins really tight, because that's what happens in a local market. And if you're not sitting flush with cash, it's pretty hard to absorb what Zillow is going to absorb at 500 million. That's a pretty big number. And we were talking earlier about what a flawed model it was, because literally they're buying properties at over market, in a hot market, over market price, and now they're forced to sell it at a below market value. So one of the things we looked at earlier today was, I did an analysis of how many homes does Zillow currently have active in the greater Phoenix market, and it's around 235, 240. And I'll let you talk to this next one, Michael, because this is a property that we kind of studied at 4750 Preserve Way, and it was just a really bad buy, and now they're paying the price for it.
Well, you can pay a price for a property in anticipation of the market running up just a little bit to it. Now, you brought up a couple of really, really good points in the fact that all markets are regional. So when you have a company like Zillow that is looking at a national basis and they're trying to convert everything into a mathematical model, that's very, very difficult to do, because each one of these markets is regional. So you hear on my YouTube podcast the fact that we like Florida, Texas, and Arizona. They're so much stronger than the rest of the country. So they don't fit into that model. Now, when you're here in Phoenix and you're trying to buy a property, you can pay a little bit up for it if it's an extraordinary property. But keep in mind, each property ages completely different than the house next door. So even if they were bought brand new next door to each other, those two houses are completely different. After 20 years, one has aged completely different than the other, as so far as maintenance, people taking care of it, pride of ownership, of course, and maybe they've been upgraded. So they are going to be valued differently. And within these regional markets, you have segmented markets. And of course, it takes a long time to develop that experience. So when you walk into a property and say, hey, this property is worth a lot of money, but algorithms don't know that. So they assume all these properties. So if we go back to that one that you're looking back, that they paid a lot of money for that property, more than I would have paid. So when we're doing a analysis of the property, that property has to give our investors a cap rate that's going to be consistent, that they can count on, and we're using that as a cross check to make sure that when we're buying the property, when we put into the rental rates that we're looking for, that after all the expenses, our investor can count on us on a return. And we have a 4.5% bench rate here in Phoenix. That's been very significant, been very consistent for the last 7, 8, 9 years. And if we get that benchmark, then that confirms the fact that the property is worth owning, and it goes into the portfolio. Now, going into this property, can you expand that at all, Paul, so we can see that? Now, the top of that chart is saying what they paid for that property. I think they paid $706,000 for that property. They set an enormous record. They weren't even close. Now, this program is just going to tell you what all the comparable properties in the neighborhood sold for. No, we've had some significant jumps. We've had properties that have gone up $20,000, $30,000 in the last 4 or 5 months. They could have had kitchens and bathrooms remodeled. And there is a difference between those properties that are remodeled and those aren't, have been upgraded and not upgraded. Not all upgrades are significant, by the way. People make mistakes on their upgrades. So, you can spend a lot of money on an upgrade because you like that and not get value for your property. So this is where experience comes in. And just looking at this comp, you can see that Zillow, in my estimation, would have paid maybe $130,000 or $140,000 more than what this house was worth.
Correct. And that goes back to something you said earlier is before the podcast is that any home can be bought, but not every bought home makes a good rental, right? So when you're looking at it from the investor side, this was an extremely bad buy, just an extremely bad buy because, they bought it at 705 and now it's currently listed at 675. So that's a pretty significant hit.
And 675 looks like it's too much. The market is telling us that house probably should have sold somehow in the upper fives. They paid in the low sevens. So, and their model is they're going to buy a property and flip it for more money than what they paid for it. Now, a lot of these iBuyers have some hidden fees to the seller. So when the seller thinks that they're selling the house at a wholesale and they're going to get a really big number for their property, the number I'm hearing is that they get a 14 to 17% discount that's paid in the settlement statement, so it doesn't show on the closing settlement or in the affidavits and in the closing cost. And then with the government agencies or recording offices, they don't show that discount. So if we got a 15% discount on a $700,000 property, it's $100,000. Is that correct? I think my math would be right. So that would put them down around $600,000, where I think the house probably should have sold. But out of that 15%, they're telling them they're going to come in and they're going to remodel the house. They're going to paint the house, put new floorings in. They're going to go put probably new kitchens and baths in. And they take that as a discount off the purchase price. But that discount comes to them as a credit on their closing statement. But now then they have to go in and do that work. So they're spending a lot of that money that they got as a discount from the seller. So their model is then to go ahead and flip this property. So they bought a property for $700,000 in order for them to sell this and make a profit. Keep in mind, this is a very expensive transaction. There are so many people that have to get paid on this. Typically, you have two real estate agents that are getting paid. You have a title company that's getting paid. You got lenders that are getting paid. Appraisers are getting paid. You have service people, inspectors. You have all kinds of, it's an incredible amount of money that's being spent. And on top of all that, you have to make a profit. That is the key to doing a flip. It's only for immediate income. It is not for creating wealth and generating wealth. That's a huge difference. Now, you can make a lot of money flipping properties, but you have to, not all properties are candidates for flipping. Zillow apparently didn't understand that. You can't go out and buy any property and expect it to perform. It's just not going to work. And I think we're going to be looking at Zillow in the textbooks for years later as to what not to do.
Yeah, I think that's a very good point because real estate really is a regional market. You have to have boots on the ground, local expertise, people like you and I that have been in the business, that have bought investment properties, fixed them and held them and sold them for profit and held them long-term for profit. You have a great video that you talk about where instead of buying a brand new car, you bought a brand new house, and 20 years later, that car would have been long gone, but the house is worth $700,000. Now that's the strategy that we try to do. So let's move on to that, and let's talk a little bit about, what we're currently seeing in the market as far as our local real estate. So down at the bottom here on a month-to-month basis, we're selling an average around 9,000, 9,500 homes a month, which is, considering the last 18 months, is a pretty good market for us here in the greater Phoenix area. So even if the 200 homes at Zillow, even if they just dumped them into the market at a low price, it's such a small number, we're not even going to feel it. So, and then Go ahead.
You bring up a good point, Paul. So as soon as the Zillow headlines were released, I had lots of investors call me, and they're asking, is it safe to be here in Phoenix and purchase properties? Well, the answer is, of course it is. We're still the number one market in the United States. We have absorption is pretty phenomenal here. And for probably the last 18 to 20 months, we've been running with virtually not enough listings for anyone to handle the demand. We're still at that point. We're about 50% less than what we really need. So if Zillow dumped all of their homes on the market and sold them, they would really only give us a 10-day to 2-week supply. So we really don't have, they're a significant player. I'd love to have 2,900 additional homes in my personal portfolio, but we'd only buy them if they made sense to us. And this is where experience comes in. We've been doing this for a really long time. I have a fiduciary to my clients. I have expectations from my clients. I'm using their money, and we have to turn them a profit. That's the same thing that Zillow had. Now, you can, as Zillow, you're entering into a marketplace that's new to you, so you can go ahead and run these. Like I mentioned before, you can run them at a little bit of a loss, but not that kind of a loss. This is obviously a failed theory for them, the failed business model, and it's not going to work for them. So here in Phoenix, we're looking to take a long-term look at these, and we want to hold these properties for a really long time. But that brings up to you the fact there's a huge difference between being a flipper and being a long-term investor. Long-term investing, you can actually create long-term wealth because we're taking a return on investment that we're going to grow. So you brought up the illustration that yes, we purchased a property. My wife was smart enough to not buy a house and buy a car and bought a house. And that's an appreciating markets or appreciating assets. So if you accumulate appreciating assets that cash flow, this is going to generate wealth for you.
Yeah, and this comes back to the models that we follow, and we run the numbers very extensively before we make a purchase offer on an investment property, because we want to make sure that, number one, it's going to cash flow for all our investors, and there's going to be a long-term hold on it. We're not in it for a quick fix and flip. It's not to say that there's not out there. I have friends that I help buy, and they do the fix and flips, but it's really not a long-term strategy if you want to build wealth. And quite often, Michael, you're talking about the retirement crisis and people that are entering retirement, and what a bad investment that is really going to be if they're just relying on their Social Security. True?
Well, you cannot save your way to retirement. You have to have an investment vehicle. Real estate, really, for me, I consider us on Main Street, because we're not on Wall Street. We're not in high finance. Most people can't go borrow and do a bond offering for $2 or $3 billion in the bond market. That's not going to happen. So the only way we can borrow money really is to go to the banks and get into the mortgage company. And that gives us an investment vehicle, and that's typically a real estate. For the average person, again, we're not going to buy commercial. You're not buying 100 units. You're not buying a 20-story office building. We just don't have the money for that. But we have requirements that we're going to need income for when we retire. And the vehicle for us is typically a single-family home. And the NAR has some terrific data showing those people that have purchased homes when they retire versus people who are renters. There's no comparison. The people who purchased homes have 30 times more than with someone who's has rented all their life. So I mean, it's a very, very significant statistic. So if owning one is good, owning 10 has got to be a lot better. So that's what we do. But you cannot, we have it in our group, Paul, we always talk about the fact that in Phoenix, every house will rent. We're going to rent every house. We have a tremendous housing shortage here in Phoenix. We're going to rent every house that we get. But every house is not a good rental. And there's a confirmation. So we have a task. So we want to buy a property that's going to go up in value. We want to buy in those growth corridors where our clients are going to go ahead and enjoy appreciation. And we want to get them in the segment of the marketplace that's going to give them the most appreciation. On the same time, we want to make sure we get a cash flow. So we want to make sure we've got a tenant, and that tenant's going to pay off your mortgage, but it's going to give a return on investment. And we want a return on investment that's going to grow. Now, to segue that back to Zillow, I don't think Zillow was selective enough in their purchasing. They used my understanding is they used algorithmic models, and I don't know how well real estate leans itself to algorithmic models. Keep in mind, real estate is not fungible. And when I say fungible, it's like when you're buying, a field of rice. If it's a jasmine rice and another field is jasmine rice, you can blend those two together and sell them all at the same price because they're all jasmine rice. Same with gold. Gold 99% pure is gold 99% pure. Real estate, not so much, because as we talked about earlier, each one of these properties is significantly different. And they have different aspects. I mean, from the day they're built, they're different. So I don't know how they fit into an algorithmic model. That's where experience comes into this. And again, if you're going to be a company and you're going to pay someone to come out and do that, you have to have someone who really knows what they're doing, and they're spending millions and millions of dollars. Now, if you have entry-level people, if you're paying them $15-20 an hour and they're making these decisions for you, I think you get yourself in trouble. And I think that this is a very big financial decision that most people make. And I think they need some experience to rely on that. I mean, I certainly would. And it's very, very hard. Look, in our business, it's really, really hard to find people who know what they're doing.
Exactly. And quite often, we've worked on deals together where, I'm a realtor investor, but I'm also a property manager here in the greater Phoenix area. And when we sit down and we analyze properties and say, are these going to be good investments for our investors? We have to make sure that our numbers are 100% correct. We're not doing some algorithm. It's boots on the ground. It's visiting the properties. What work needs to be done? What are the expenses? What are the carrying costs? And what's it going to take to turn this property around to be a good investment for our investors? So you're 100% right. Like you cannot rely on the algorithms to tell you if it's a good investment or not. And I think Zillow might have thought that they were so flush with cash and their revenue streams are so fantastic that they're too big to fail. And I think maybe they thought they could dominate the market. And I don't want to turn this into a bashing Zillow session. It's more of an analysis of a business model that really doesn't work on a national scale. It's more of a regional, very local scale in order for it to be effective.
Well, Paul, you've been in business a long time. You know how these time frames can get away from you. I know Zillow says that they're paying cash, but they're really not paying cash. They have a bond. They have a bond issues, and they have to pay on that bond. So it's not their money. They borrowed the money, and they have to pay that back. I'm not sure what their cost of money is, but absolutely every single day that they're out there, that they're not selling that property is costing them money. Same with all their projects. It's easy for these projects to get away from you. That's why you have project managers. And if you're not paying for a really good project manager, a project could take 30 days, could easily cost you 60 days or 90 days, of which you are paying for all that. And here again, if you're not doing correct analysis, each one of these properties needs an analysis on them. Someone has to look at it. Someone has to design whether or not this is in the buy box or not in the buy box. Just because the numbers say it is, you have to go out there and confirm that. And I think that's what they've not done. We do that on all our properties. Otherwise, you have a failed property. We're not interested in failure. So I don't know what Zillow is paying for this, but you have to know, and there's statistics. In order for you to lose $500 million, you had to have bought the property in an appreciating marketplace. You had to really, really make a mistake when you bought that property. You just had to make a tremendous mistake when you bought that property. And you're taking too long to get things done. and the costs are way too high. So the whole model seems like it's wrong. Now, there are lots of successful models out there, but this one is not one of them in the real estate business. I've been selling to REITs for a really long time, and a lot of these guys really are very, very savvy. What they understand. But I think Zillow's got some problems. So you can go back to the statistics and just kind of talk about what's going on here. Because the question I'm having from investors, of course, as soon as it's hit the wires, what's going on in Phoenix? How is it that they're losing money? Well, Metro Phoenix, this one here comes from one of our statistical analysis companies. They're pretty phenomenal. They're just telling you, even as I think is this September?
This is a September report.
Yeah, so September report still says that we're really low on listings. We're 11.5% below last year, and last year was not a stellar year. And you can see that monthly sales are up almost 24%. So you really would have to make a huge mistake not to make money here in Phoenix. Phoenix is just such a wonderful, wonderful marketplace. I mean, how many people are coming from California alone, Paul? You and I talk about this.
That's a very good thing to bring up. We get 200 people a day on average coming from California alone. And they're coming from the Bay Area, Los Angeles, Sacramento County, all those places. And I think Sacramento was just listed the most unaffordable city in the United States. So when our California neighbors come over here, their first stop is Maricopa County, they see our properties and our property values. And quite often I'll have them ask me, what is that property worth? And I'll say $650. And they say, great, I'll buy 2 of them, because it's such a great value for them. And
well, that might be what happened with Zillow. I think they're a Seattle-based and West Coast-based company. They came here to Phoenix and they thought, well, our prices are really, really reasonable, which they are. They're very, very reasonable. But again, each one of these markets is different. This is not San Francisco. This is not Seattle. This is Phoenix, Arizona. And, our market is changing and we can count on some change. We've had some wonderful appreciation, but you can't pay $100,000 or $150,000 over market. And just going, and literally, we went back to that first one. Out of the 20 sales, their purchase just stood out because their purchase was like $700,000. The next one was like $525,000 or $530,000. So they paid a lot more than everybody else did. And you can't do this if you're gonna make money. So I don't know how that happened. I don't want to beat these guys up, but it would not happen for us. We have checks and balances. We go in when we're doing our analysis on a property, and each one of these is done. We call that scrubbing. So we go into the marketplace and scrub the properties each and every day because the market always, we have a very active market. We have lots of properties being sold, a lot of properties coming to market, and we see opportunities every single day. So we want to make sure that these properties fit into our model. And we have to scrub those. And so it takes us hours and hours and hours to do this. We don't have computers to do this. This is done by hand. So
that's a good point, because a lot of our investors are not REITs. They're not Wall Street. We're Main Street guys. We're
Main Street guys.
And a lot of our investors are mom and pops, anywhere from 1 to 5 properties. And then we have, a handful of them that are 10 to 50. And so we have to protect them all because they don't have a $2 billion cash fund that they can sit on like Zillow does. Every purchase, every item, every transaction, every business expense is important to them, and it affects their bottom line. So they're really counting on us as local experts to know it and to analyze these properties and to and do the fiduciary thing and protect them. So in closing, Michael, how about some closing thoughts here for people that are going to be watching this?
I think that Zillow made a mistake. I think that the Phoenix market is still phenomenal. It's just an absolutely outstanding market to be in. We have trends here that have been decade-long trends. You have you have demographics like the baby boomers like me. The moment you retire, there's an allergy that kicks in, and that allergy is the cold weather. So they all want to move down into the sunshine. That's why Florida, Texas, and Arizona, because there's a huge baby boomers. Remember, there's over 10,000 baby boomers every single day retire, and a lot of these are moving south. So we pick up that trend. And we have a trend of people leaving California. They can't get out of that state quick enough. And if you think that trend is going to stop, well, then maybe we'll slow down here. But we see absolutely no sign of it abating. We cannot build enough homes to accommodate the people coming over here. And of course, the city is absolutely vibrant, just vibrant. So even without California, we'd be attracting all kinds of people. You know, the Mayo Clinic is here, and they now are a teaching hospital, expanding the medical, and the medical research is phenomenal. We've got chip plants being built. You know, you have the new Taiwan semiconductor that chose Phoenix to build its big plant. They have 8 microchip plants under construction right now. Intel, not to be outdone, announced 2 more to their campus. I mean, they have a huge semiconductor campus and presence here. Plus the military's here, and we have trucking and industries. It's just vibrant. You know, we're getting 150,000 people a year coming here. So Zillow, I don't know how you blew it. I just don't know how you did it. It's too terribly bad. I wish you a lot of luck. I hope you get this done. If you want to sell any properties, give me a call. We'll buy some of them from you. We're more than happy to do that. So we'll have to scrub them, though. We want to make sure that they fit into our formula, but we can do that. We'd be more than happy to pick some of those up.
Yeah, that's a great point you bring up. You know, I think one of the best kept secrets here in Arizona, there's a couple of them I always talk about, but the Phoenix Business Journal is a great informational newspaper that is put out. And I receive that every other week, and they're constantly listing new jobs, new employment opportunities, new expansions, companies moving their headquarters here. So, and the high-tech investment that is going on in Arizona is a very good environment. And again, I'm going to steal a couple of your phrases, Mike, but unless there's a Mad Max event or some kind of calamity in our environment that changes the fiscal output or outlook for the greater Phoenix, Arizona area, our housing market is going to be strong for quite a while, because we're constantly being asked, oh, is this the bubble? Is this going to crash? Is this going to be the end of it? And I have people that told me last year that said they weren't going to buy because they were waiting for the prices to come down. Now they're coming back to me looking at the same or similar homes that we looked at last year at $100,000 more. And they're all telling me, I wish I would have followed your advice last year, and I wish I would have bought. Michael, you can talk to this, because in your model, it still shows that we're in an accumulation phase and prices are still going to rise, maybe not as dramatically as they've done over the last year, but they're still going to go up.
You know, we can look pretty confidently out. I think the Crawford report here is a great statistical company. And I think if you follow their work, they look 12 to 15 months out. They don't see any problems with the economy. I don't see any. You know, you go talk to all our builders, that they're just jammed. They're looking at 12 to 18 month delivery times. Their concern is that they're going to sell you a house at $500,000 and it costs them $600,000 to deliver it. That they'll lose money on every one that they build. So that's one of their concerns. I mean, that's a legitimate concern for our builders. So I don't see that concern. I understand where you would say, oh my gosh, what happened because of Zillow? I don't see, and I think the market here is absolutely outstanding. This is probably the #1 place in the United States to invest. I think you'll do really exceptionally well. You know, the growth is here, the economy is here. You know, it's easy to do business. We're a pro-business state. There's so many nice trends that are going on. These are decade-long trends you know, they say your trend is your friend, and I see that happening here in Phoenix. I'm still buying. I think it's a wonderful place to buy.
You're right. It is a pro-business state, but also it's a very landlord-friendly state. So for people that are buying investment properties and looking to be a long-term player, a long-term hold on them, this is the market for you. So in wrapping up, don't go it alone. We're experts here in the local market. We hang our license with West USA Realty. They do all our back-end work. Michael is an expert. He's helped tons of investors. I manage a lot of properties for investors here in the Arizona or the Phoenix, Arizona area. So reach out to us and we'll be happy to help you. Thank you, Michael, and we'll see you next week.
Thanks, Paul. See you, man. Bye-bye.